channel. I'm here to share with you about the market update. Investors are betting that the peak interest rates have climbed up to 5.3%. And what happened to the UK stock market after hitting a record high? The Fed's preferred inflation indicator this week, and a sharp increase in the consumer spending is expected to spark a debate among central bank governors on whether they need to adjust the pace of rate hikes. The U.S. Personal Consumer Spending Price Index is expected to rise 0.5% in January month-to-month, the biggest gain since mid-2022. The Core Price Index will rise 0.4% according to economists. The Core Price Index does not include food and fuel, and better reflects underlying inflation. These monthly gains are expected to slow the annual inflation slowdown, which now remains well above the Fed's target. In addition, Friday's data will highlight full spending by U.S. consumers, with economists expecting nominal spending on goods and services to rise by the most since October 2021. This week's report is also expected to show the biggest increase in personal income in a year and a half, driven by the resilience of the job market and the sharp increase in the cost of living for Social Security beneficiaries. In summer, the revenue and spending data are expected to show the challenges the Fed faces in its most aggressive policy tightening activity in a generation. The report follows data released last week show a sharp increase in U.S. retail sales and higher than expected consumer and producer price indices. Investors have been stepping up their bets on how much the Fed will raise interest rates during this tightening cycle. They now expect the federal funds rate to climb up to 5.3% in July. Based on the interest rates future, just 2 weeks ago the unemployment rate peaked at 4.9%. The minutes of the Fed's latest policy meeting will also release on Wednesday. The Fed raised its benchmark interest rates by 25 basis points at the meeting. The data could help reveal policymakers' willingness to raise interest rates more sharply when they meet again in March, following recent comments from some officials. Cleveland Fed President David Mester said this week she saw a compelling economic case for another 50 basis points earlier this month, while St. Louis Fed President James Bullard said he didn't rule out as supporting a March rate hike. This week will also release new and existing home sales data from January and a second valuation of gross domestic product in the fourth quarter. What happened to the UK stock market after hitting a record high? While the US stock market fluctuated on expectations of higher interest rates, the A-shares are still worried about defending 3,000 points. The UK stock market has quietly hit a record high. Britain's FTSE 100 index closed above 8,000 for the first time on Thursday, after falling 0.2% on Friday. One analyst concluded that the reason behind the UK stock market record highs was that boring was the new investment trend. Boring refers to the stocks of energy, commodities, consumer staples, and healthcare companies. The stock index has repeatedly hit new highs. In the tough year of 2022, soaring inflation, central bank interest rates, and falling consumer confidence swept stocks around the world, sending the S&P 500 down nearly 20%. The Nasdaq down 33% and the Hang Seng down more than 15%. The FTSE 100 price index rose 0.91%, putting the index itself at a high level. In 2023, global stock market rebounded and US-UK stocks were not to be left behind, up about 7.44% so far this year, leading the FTSE 100 to easily hit a record high. However, with the European stock 550 index up about 13% and the Nasdaq up more than 12%, the UK New Year's gains were not outstanding. In terms of individual stocks, the top 10 components of the FTSE 100 index are Shell, AstraZeneca, Unilever, HSBC, Diageo, BP, British American Tobacco, Glencore, Rio Tinto, and GlaxoSmithKline. Energy and resource companies have benefited from the conflict between Russia and Ukraine, and giants such as BP and Shell have recently posted record profits. Azena and GlaxoSmithKline also did well before coronavirus continues. These weighted stocks have supported the index. The exchange rate is also an important factor, and the weak sterling is also a positive for many multinational companies, helping them generate dollar revenues overseas. New investment trends. Of course, in addition to short-term market factors that drive money into a market that has been dormant for years, analysts have found structural changes in investor behavior. While the FTSE 100 hit a record high, the FE 100 overall is still very cheap at 10.7 times forward earnings, compared with 15 times the MCCI Global Index, said Jason Holland, managing director of online investment platform Best Invest. This suggests the potential for further gains in UK stocks, which also have an attractive dividend yield at around 4.0%. Holland in recent years. Many investors have considered British blue-chip stocks, boring and non-energy groups, bankers, utilities, and consumer staples, citing high-growth tech stocks such as Apple, Tesla, Amazon, and Google. Holland added, but in a more difficult economic environment, robust companies that offer reliable dividends are well worth considering. Boring is the new investment trend, and the FTSE 100 with plenty of stocks in energy, commodity, consumer staples, and healthcare companies appears to be well positioned in the current environment. On the economic front, despite expectations of a recent recession, both the UK and European economies have so far performed slightly better than expected and avoided a recession. Last year, the British economy has been somewhat stable. At the same time, the mild weather and high levels of gas reserves have helped the region to avoid a crisis of energy shortages. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.